Alright, let's talk about Sanan and why people keep comparing it to Wolfspeed. Spoiler alert, it is not the same story. Sanan is currently going through a transition phase, moving from LEDs into silicon carbide, which is arguably one of the most difficult materials to scale in semiconductors. At the same time, it's part of a major 2023 joint venture with STMicroelectronics to build a 200mm SiC capacity in Chongqing, China, where they're supposed to spend an expected $3.2 billion, including capital expenditure of about $2.4 billion over the next 5 years. So yes, this is big, and yes, this is complicated. Recent developments around Sanan have raised questions around execution, financial pressure, and how quickly the silicon carbide ambition can realistically scale. Because according to the news, Vice Chairman and General Manager had been detained and placed under investigation by Chongqing District Supervisory Commission. This is important because it's a signal of something bigger happening, not just for Sanan but also for ST or maybe the entire SiC industry. Now, before we go any further with this, let's clear up with the Wolfspeed comparison. Wolfspeed is more of a capital market driven expansion story, depth, aggressive scaling, and very sensitive timing. Sanan is different. It operates within a more structural supported ecosystem with stronger regional backing. Or in simpler terms, one is Wall Street stress, the other is industrial policy with extra steps. Now let's zoom out a little bit, because silicon carbide is not just a one-layer story. You can think of it like a stack, or like a cake, a 3-layer cake like Jensen Huang likes to put it.
AI is a 5-layer cake.
At the bottom you have the demand. EVs, industrial power systems, energy grids, and yes, even AI data centers. So demand is not the problem, and if anything, demand is still growing. Therefore, this is not a demand collapse story. In the middle you have companies like ST and Infineon. These are the ones spending billions building silicon carbide capacity. And here's where things get interesting. They're not struggling because nobody wants silicon carbide. They're struggling because scaling silicon carbide is expensive, slow, and slightly painful. Kind of like upgrading your entire kitchen while still trying to cook dinner every day. And yes, the bills are real. Now in the upstream layer, where Sanan sits, this is where the real challenge starts to show up. We all know that there's a significant capacity expansion happening in silicon carbide wafer, both worldwide and in China. And I've also posted a video talking about China's silicon carbide market consolidation, which you can watch here. But capacity announced and capacity actually qualified for automotive use are two different things. You can also watch a video about that up here. Because in silicon carbide, the difficulty is not just building capacity, it's achieving stable yield, consistent quality, and full automotive qualification at scale. And that process takes time. So the issue is not whether the capacity exists on paper, it's whether the capacity can ramp reliably in sync with downstream demand. From my personal on-the-ground experience in China, there's also a noticeable difference in how silicon carbide wafer suppliers are commercially accessible. With some established vendors, you can typically initiate a standard sales inquiry, request samples, and discuss small volume supply depending on qualification. But with Sanan, the pathway does not really function in the same open market way. And that suggests a more allocation-driven, program-based supply structure rather than a broadly accessible commercial distribution model. Now, let's connect the dots. I would assume that ST is building downstream capacity based on the assumption that upstream wafer supply ramps successfully, and likewise the application growth progresses as expected. But if that ramp is delayed, ST cannot just leave multi-billion euro equipment idle. Because idle fabs are basically the semiconductor version of paying rent on Ferrari you're not allowed to drive. What? Expensive, emotional, painful, and very visible to shareholders. So what happens then? ST may have a few options. Diversify suppliers, adjust ramp timing, or increase internal sourcing over time. But every option comes with trade-offs: cost, time, and dependency. And this is where it becomes a global story, because silicon carbide supply chain is inherently cross-border. You have upstream materials and growth concentrated in certain regions, device manufacturing led by global players like ST and Infineon, and end demand driven by EVs, energy infrastructure, and increasingly AI-related power systems. So basically, in other words, when one part of the chain slows down, the impact does not stay local, it propagates throughout the entire ecosystem. And this is where the bigger picture comes in. Europe is trying to build resilience in critical technologies like silicon carbide. But Europe also has structurally higher energy and manufacturing costs and remains more exposed to global energy price volatility. So producing locally is expensive, but relying externally creates dependency. So the strategy becomes pick your pain, high cost or high dependency. Neither is fun, just different flavors of uncomfortable. So when people say Sanan versus Wolfspeed or Silicon Carbide collapse, I don't think I fully agree. This is not a collapse story, it's not even a demand story, at least for now. It is a coordination problem across an entire supply chain that is scaling at different speeds. Thus, my argument will be that the real challenge is, can the ecosystem scale fast enough without breaking the economics, the timelines, or the synchronization between supply layers? Because right now, it's still figuring that out. And if you've watched so far, thank you for staying with me. On a personal note, this topic is very close to what I'm currently working on. The idea is not to replace existing silicon carbide ecosystems, but to help improve how silicon carbide wafer manufacturing capabilities can be developed in a more distributed and resilient way, especially close to end demand like in Europe or other regions. At the core of this one principle I have taken with me: think globally and act locally. China today is clearly a major manufacturing hub for silicon carbide wafers, and there is a lot to learn from being embedded in that ecosystem rather than trying to operate outside of it. What I'm pursuing is how parts of that industrial knowledge, for example furnace systems, parts, consumables, crystal growth methods, and process know-how, can be translated into a more diversified and resilient supply structure. Because in silicon carbide, and also in many other technologies, the real challenge is not only the technology itself. It's also about supply chain resilience, making sure that the system does not depend too heavily on a single ramp, a single geography, or a single execution path that has not yet fully proven stable at scale. And that is exactly what de-risking means in practice. Not avoiding ecosystems, but building optionality, improving transparency, and reducing single-point dependency in a capital-intensive industry. And this is also why I believe step-by-step development matters more than all-in or nothing industrial bets. Not everything needs to be a multi-hundred million or billion-dollar leap at once. In many cases, resilience is built through iterations, feedback loops, and gradual alignment between technology, manufacturing, and real demand.